Nick, tell me where you stand on the markets right now. You're one of the great market watchers out there. Puts out, those of you who don't know, DataTrek puts out an outstanding daily newsletter. You're sort of you're not a quant trader, but you use quantitative analysis for the stock market. You analyze massive sets of databases and look for clues. You mine for clues. What do you see happening in the markets right now? The big question is, are we going to avoid a recession or not?
Yeah, so the short answer is we're in for some more trouble. We got two problems. The first is oil prices seem to still want to go higher. At 140, they're a double year over year. That's the signal of a recession coming. It always happens. When oil doubles in a year, you get a recession in the next 12 months. So that's the thing to worry about. My other concern is earnings expectations are way too high for the back half of the year. We've been doing $54 a share in S&P EPS every quarter for the last 4 quarters. The street's at $60 and $61 a share in the back half of the year. Those numbers have to come down. They're just irrationally high. And the market understands all that. The market's discounting those already. But until we see earnings cuts and continued growth and oil prices come in, I think we're in for more trouble.
I honestly don't understand this. I've been watching the markets for 25 years as the stocks correspondent, and I am amazed they have not taken the earnings estimates down this year appreciably. So we're still looking at 10% earnings growth for the S&P this year, another 10% in 2023. And so the decline in the S&P 500 this year is entirely due to the multiple being compressed. It's not the earnings actually going down. If earnings go, I think it's 228 now we have for the S&P from 208. If we go flat on earnings, that would imply another potential 10% down leg in the market. That's how a lot of these strategists get to 3,400 really quickly. Well, but you were an analyst, right? You write about this all the time when you were an analyst. Why aren't they? The market seems to believe that they should be taking the numbers down, that the estimates are too high for the second half of the year, even if there isn't a recession, and yet they're not doing anything. What is it that everyone else sees that the analysts don't want to see? Or is there a lack of creativity among the analyst community?
No, the analysts really want the guidance of the companies before they cut numbers. They don't want to go out on a limb and cut a number that the company will say, why are you putting out this low number? It's that feedback loop between the analyst and the company that prevents the right numbers coming out.
But what's the value of an analyst if the only thing they're going to do is, we're not going to do anything until the company guides us? Who needs that? There used to be a lot of more independent thinking on Wall Street.
There was. Look, there's an old saying about analysts. In a bull market, you don't need them. In a bear market, they'll kill you. We're in the second part.
Yeah. Remember the 2003 analyst settlement, the global settlement that Spitzer did? Spitzer correctly called out the conflict that existed, sued the community, and came to a deal. And what I saw after that, you tell me, you were around, the brightest left. On the sell side analysts went to the buy side. Some of them tried to set up their own shop. I saw pay dramatically drop. I saw a lot of people making $1 million plus a year in 2003. I don't know what the average pay for a sell side analyst now is, but I'll bet you it's probably $300,000, somewhere around there. So the best and brightest left. The pay dropped dramatically. And what I see, this is a broad statement, so forgive me, the intellectual quality of sell-side research has declined dramatically. I get most of the street's research on a daily basis, and a shocking amount of it is garbage. There's no real value in it. My point is there was more creativity, outside-the-box thinking, and, meta-analysis, whatever, than there is now, where you correctly point out they're just waiting for the CEO to tell them something. So I'm editorializing on here, but I feel very strongly about it. If we believe, direction of earnings is important for the street and where prices go, and analysts are just no longer doing anything, the whole model kind of gets called into question here. The street starts moving independently of the analyst community.
Yeah, no, that's true, but at least the market discounts it before. So at least asset prices are being correctly set. What we're seeing right now is that worry. And by the way, the market peaked out at 33.87 in February 2020. The S&P is still 20% higher than that today. Every other global market is below its February 2020 levels right now.
So we're outperforming,
dramatically.
Although I did note in May, Europe did a little bit better. I think we were up 1%. China was up 1 or 2%. S&P was 5%, but that's a pretty small dispersion. It was pretty even overall. It's kind of, everything kind of flattened out second half of May.
I had exactly the same thought running the numbers last night. Everything's so tight. A little bit here, a little bit there. EFA was up 2, EM's up 0.6, S&P and NAS are flat, or S&P and Russell are flat, but still very tight.
Yeah.
And it's tight year to date.
Yeah. What does this mean for your investors? Do they pay more attention to things like earnings, or are we actually sitting around saying, are the active traders are more interested in momentum trading, classic momentum trading?
So they'll look at earnings when there is momentum behind it. I mean, on our platform, we also offer analyst ratings for customers or our clients to look at for every stock. Yeah. Right, and this is this is not naming Goldman Sachs, JP Morgan. It's an average of all analysts across the street. It's one of our least looked at pages on the platform. Really? So retail investors, at least active retail investors, are looking for that momentum. They are playing earnings, but not taking sides because an analyst says so, taking sides because of peers.
Yeah. And because this is an ETF show, I want to get your thoughts on sectors, because that's what people trade the most. Give us your view on sectors in the second half of the year. Is energy going to continue? Give us some large macro themes here.
Sure. So, yes, we still love energy right here. I think it still has a lot of room for multiple expansion, and the numbers are going up. Unlike the conversation about the market as a whole, where the numbers have come down, ExxonMobil, Chevron, all the energy names, estimates are rising. So energy is fine. A lot of our customers are looking for safe havens, and for us, it's healthcare, like the XLVs, the large healthcares of the world, because when growth investors can't buy tech because it's been imploding, and can't buy retail because that's also not doing well, the only third road left is healthcare. And we see this over and over and over again. Every cycle sees healthcare as a percentage of the S&P peak at the bottom of the market. Happened in 2000, 2002, happened in 2009 and 10. We got another point or two to gain with healthcare. So that's got multiple expansion in it as well.
Well,
those are the two sectors.
Every day. I mean, Lilly last week new highs. Merck was at new highs the week before.
Yep.
Bristol was stronger. So all of that is playing out exactly like you're saying on the playbook.
And it will continue to do so as long as we have these worries about recession. Numbers have to come down.
So do we avoid a recession? I'm sorry to hit you with such macro stuff. It makes you uncomfortable, but that's what people want to know. Tell me if there's a recession, I'll tell you if we're at some bottom right now.
Tell me if oil goes to $140, and I'll tell you if there's a recession. Because if it
goes to 140?
140.
And that's the doubling that you were talking about?
That's the doubling, yes. In the current environment, I don't see a way to avoid a recession. If Russia-Ukraine solved that war and oil prices came back down below 100, we could easily avoid a recession. In the current environment with current trends, very hard to see.
So you think there's a good chance oil goes back over 140?
Yeah.
Because?
The last peak at 140 was July of 2018, right around July 4th weekend, which is peak summer driving season. And we're heading there right into exactly the same setup right now.
That's a good point. Anthony, any final word here?
I just think people aren't looking at the macro version of what happens with China-Taiwan intervention. I think there's a lot more rain down the road, so I think we need to be cautious.
On Taiwan, China, you said?
Taiwan, China, yeah.
Do you think there's chances for conflict in 2023, for example? I mean, is there?
It's going to look different than Russia invading Ukraine, but from conversations I've had with people overseas, it seems like China is definitely going to make some sort of headway into Taiwan by the end of this year, maybe even next year. And that's something we're not even talking about in this macro environment.
Yeah, that would certainly be another kind of game changer. How would that change the world?
Well, then you got global recession for sure, and a pretty deep one. And forget about electronic supply chains, right?
Yeah. So the probability of this, you think, are fairly high? You think so?
Maybe talk to Ian Bremmer on that one.
Yeah. Well, that's an important point here. This is another potential, not a black swan event because it's a known unknown. It wouldn't be an unknown unknown. That's actually weighing out there.